Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from Miami at the Exchange ETF conference. Joining me for this segment, we have Bryon. He's the Global Head of ETF Solutions at JP Morgan Asset Management. It is great to see you as always. Welcome back to Trade Talks. And it's interesting, the content we're covering this year is a little bit more fixed income focused than it has been in the past. Give us some macro overview.
Yeah, bonds are back, right? I mean, I think if we'd have been here a couple years ago, there's no yield that you can get out of bonds. And so the question was, what role does this play in my portfolio? Now with yields back up, after the Fed raising rates the way that they have, it's made it a very compelling part of the portfolio, and I think that's going to be important. Now, how investors get that exposure, I think, is going to be interesting. Of course, on our side, we think active management is a great way to do that. We've got an ETF, JPI. The idea is high yield like yield with less volatility. Currently yielding 8%. That's a very attractive thing for investors in their portfolios.
And that really seems to be some of the key themes here. Fixed income, active management certainly back in favor, and focusing not only from a value perspective, but fundamentals for sure.
Yeah, 100%. I don't think active was ever out of favor on the fixed income side. I mean, if you look at historical flows over the last decade, investors have always been embracing active fixed income. They want to control duration. They want to understand credit quality. They want to make sure that they don't have defaults in their portfolio. That's an important part of that, but you're absolutely right. The quantitative easing that we had lifted a lot of boats, and now that that's coming back out of the system, you do have to get a little bit closer to the valuations and make sure you understand exactly what you own. Active management provides intentional investing where the portfolio manager knows every single security they own in the portfolio.
And you thought 2022 was big for active management, and 2023 can be even bigger.
Yeah, just getting started, right? So 2022 was active coming on the scene. Going into the year, active management was only about 5% of total ETF assets, but accounted for 15% of the net flows over the course of the year. This year, active's already 23% of the net flows. And so I absolutely think investors, as they understand what active can do for their portfolios, are going to be using a lot more active ETFs.
Right, especially if you're also benchmarked to an index where 5, 6, 7 stocks have such a big weighting. If you own them, that could be great in a good year, maybe not so much when you see markets as volatile as they have been.
Yeah, and we're not so sure on recession right now, but like to your point, valuation is going to matter. When an active manager can do security selection on companies that are going to thrive through different types of environments. Maybe we do go to a recession, we don't go on that vacation, but you're going to spend more time playing video games or something like that. What company do I need to own that's going to do that? Instead of buying the whole index, you might want active management that's going to help you select those spots.
And that's a great way to illustrate it. Bryon, we appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.